I want to bring up to the podium today is Arlene Martin with Huntington Bank and Jacob Stern with Summer Corps 504. One of the fun things that I get to do and there's two Lanoliers. Pick one up and that feeds into the system. And Jake on that too. Some of the fun things is in addition to the Select Chicago program, the GWDC has something that we're starting to christen towards an Invest Chicago program, which up in some of our economically challenged areas, a lot of the programming revolves around access to capital. They sit on a advisory board with me. We meet monthly and are working with everything from microloan all the way getting up to EB5 investment. We've been spending a lot of time this summer talking about that and what, I'm going to have them talk today, really answering some really fundamental questions about, let's pretend that you have an entity established, you have a bank account here, and you are looking to do a small to medium scale project. And I will let them define what a medium to small scale project is and what the real programs that they can use to help move these projects from a concept stage to a ribbon cutting. So Jake, go ahead. I'll let you start.
Sure. Thank you, Michael. It's a pleasure to be here. Am I on? Can you guys hear me? Yeah.
Yeah, you got to talk into the Landolier.
Move it up a little bit.
Yep.
There we go. Like Michael said, my name is Jake Stern. I work for Summer Corps. Summer Corps, the name is not as explicit as Select Chicago or Select USA, so let me explain what we do. Summer Corps is a CDC, which stands for Certified Development Corporation. The Small Business Administration is who certifies Summer Corps and many other similar entities that are authorized to do certain types of SBA lending, and that's done on a state-by-state basis. So Summer Corps right now is exclusive for the state of Illinois. If you asked us to be transparent, we have sort of ambitions to grow into neighboring states, but right now the programs that I'll discuss are pertaining to the state. And Summer Corps, we really see our clients and partners as being municipalities, townships, economic development organizations, banks, and of course small businesses. So we do a couple of different SBA lending programs. I'll dive into some of the details on that. And then we also have a contract to administer a couple different small incentive programs for small businesses in the city of Chicago. So our core product is the SBA 504 program. So this is tailor-made for a small business that's looking to expand and grow through the purchase of fixed assets. So a facility for their business, perhaps that they're in now. So it's sort of a rent replacement deal where they've been renting at a facility for a while and they finally convinced their landlord to sell to them. Or they're growing out of their current space and they're looking to move to another space and they're seeking financing to purchase a building or purchase a second or third location. That's sort of the ideal template for this program. As well, it helps small businesses purchase machinery and heavy equipment. So the structure of this program is designed to benefit the small business and the lending partners with an S. So how it works is you have a bank and a CDC like Summer Corps partner together on the project. So a bank will do 50% of the project's financing, and we're looking at this as LTV, loan to value. So a bank will lend 50% of the project's cost and have a first mortgage on the property if it's a purchase of real estate. And then you'd have Summer Corps, a CDC, come in and do 40% of the project's financing with the second mortgage and the second lien position. The bank has its terms and its interest rates. Summer Corps has terms dictated by the SBA, and those actually change month to month, and they're tied to the sale of treasury bonds. Right now, Summer Corps' rate for real estate purchases is 4%, 4.01, and we can do a 20 or 25-year fixed rate. And so what ultimately the small business has is sort of a blended rate between the bank and Summer Core. And if you did the math, so 50 plus 40 leaves 10. And so the borrower then has to come up with a 10% equity injection, so cash investment into the project, which is definitely better than if the business were to go just pure conventional. If they can afford it and they can get just a conventional mortgage from a bank like Wintrust, Bank of America, Chase, that may be the right fit for them. But if they're looking to preserve some of their capital so they have it for working capital needs, for instance, then the SBA 504 program is there to help. It also makes the bank lender more comfortable because they're going to have 50% exposure, not 75% or 80%. And then it's great for the business because you have the certainty of a fixed rate. You have a blended rate that's more competitive than if they'd just gone conventional probably. There's no worry about it changing to adjustable in the future. And so that's the deal. So I probably went on into maybe too many details, but I think the structure is important to understanding what it is. In terms of foreign investment, for a company to qualify for SBA financing, 50% of the operating company's ownership has to be a permanent resident. So it's not frequent that we see foreign direct investment in these types of deals, but it's not exclusive to it. Or you could have that scenario, but it would have to be sort of a partnership deal where someone has already established permanent residency, also known as a green card, or maybe it's someone who had moved from abroad and has settled in to the point where they can get permanent residency, and then they would be eligible for this type of financing. Summer Core also does a smaller SBA loan that's designed for working capital needs. It's a loan between $50,000 and $250,000. And then lastly, another thing we do is we administer 2 incentive programs for the city of Chicago that are focused on small businesses, so retail, but also small industrial, that are doing building rehab. So if you're a doggy daycare, a daycare, or a food manufacturer, and you're in the city of Chicago, it is geography specific. So one program is funded by TIF. You guys are probably familiar with tax increment finance. Chicago is a big user of that tool. You can apply for funds. Summer Core helps facilitate that process for you. You get a project approved, and then you get funds reimbursed to you after the project's complete. So that's sort of the breadth of what we do.
Great. And then with Arlene, I'm going to bring it back a little bit because Jake was really great in laying out this whole path to his program and using that as a source of capital or a means to getting to a project or purchasing a project. And so Arlene, you've been working with me since, 2011, 2012, working with small to medium businesses, emergent businesses, and I saw Michael come back with all the programs that he's doing with startup incubating clients, where businesses, once they get established as a resident here and I'll ask Steve Kemp a question. Steve, if somebody's here on a business visa, does that work with them as that resident requirement that Jake was talking about for?
So what I mentioned was for an SBA loan, to qualify, you have to have 50% of the operating company's ownership needs to be permanent resident, so a green card.
So it's a green card and not a business visa.
Yeah, a B1, B2, that's just a visitor's visa. So
Okay.
Nothing to do with the green card. The eligibility for green cards are all,
The E's and stuff like that. Okay, great. And so basically, because the whole point to this panel is making sure as folks that are coming in from abroad, they're looking to establish businesses here, they're looking to acquire real estate and assets here, that there is a path that they can do to that to get to that point. And Arlene's going to break down a little bit more on just some fundamental, banking business terms, but as it relates to that 504. And so.
Sure, thank you. So I'm Arlene Martin, and I'm an SBA lender with Huntington Bank. And Huntington Bank has been around 150 years, so a bit of staying power, and it's $100 billion in assets. And with SBA lending, we focus on an 8-state Midwestern footprint. And so today what I want to talk to you about is the 7A programs, and I can touch on some other things as well, Michael, as I conclude. But the 7A program is a phenomenal program that's designed to assist business owners that want to start up a business, expand and grow, and they may do this by acquisition, by literally buying another business. And I think that was mentioned with our attorney panel, how many times a business will come into our country by acquisition and other means. So that's a great avenue for 7A. Some of the benefits that business owners will receive by taking advantage of the 7A loan program are the smaller equity injections. And so rather than a conventional program where you might be looking for 20 to 25 to 30%, in an SBA type of platform, we're looking for 10% equity. So you're able to preserve your cash equity and keep that for other means within the business. Post liquidity is always great once you've closed on a loan to have that additional capital available to you. So that's really important. With an SBA type of loan as well, the bank can offer longer terms and amortizations, which ultimately improves your cash flow. And as we know, as you're running a business and you're expanding and growing, the cash flow conversations can be a little bit exciting at times, and something of a roller coaster depending upon how your receivables come in and other things of that nature. So having a nice, strong cash flow position, being able to manage a lower payment is really critical for you as you're going into the growth mode. The other thing that SBA 7A offers is a flexibility in terms of collateral. Many times we're looking at loan requests where, particularly in business acquisitions, where the loan is not 100% fully collateralized. And so on a conventional basis, it's difficult for a lender to provide the full amount of the request. Under an SBA platform, it's absolutely possible. So that's a very, very nice feature for 7A financing. And then finally, there are situations where, as I've described on the conventional basis, it doesn't fit into their underwriting box, and so that deal might not have been approved had it not been for an SBA type of platform and approval. So the types of businesses that are best suited, really SBA can address quite a few different types of industries. We're looking at businesses that are starting up and potentially up to $1 million in startups, which seems like a pretty high number. It really depends on, with the larger loan amounts, we're looking for more in terms of requirements, a higher cash equity position for sure, 20 to 30%, strong business plan with really robust and understandable projections, strong outside income from the borrower to cover personal expenses, and whatever collateral that they're able to pledge. But startups are definitely a conversation for 7A loans, which can be very important to you. In addition to that, the purchase of real estate purchase and large equipment can be handled on a 504 platform as well as the 7A. There's differences and advantages and disadvantages to both, but equally it's available in either case. With 7A though, we can target and really focus on business assets. Beyond the equipment. We can provide financing for growth and in the business acquisition, as I've already mentioned. 504s are somewhat limited to the equipment, large and real estate. So those are the two key differentiators, I would say. In either case, we're talking about minimums of 10% equity, which is really, really quite exciting. Now, in terms of the loan amounts, with an SBA loan, we max out at about $5 million on a 7A. We also offer USDA financing. And so that can occur in those rural areas, and that lending can go up to $20 million. So that really gives you a lot of additional capital access in the rural communities. And I'm sure there is some in the room here. So with that, what we're looking for, so as you're making applications to banks, and to CDCs, the best likelihood of success will occur if you have a well thought out business plan, if you're relying on projections for your financing, if you have a complete package of information, I think the attorneys did a phenomenal job of talking about what's important and making sure, you bet, making sure it's done well and done correctly. And we as lenders absolutely appreciate that, without a doubt. So that's important to think about, and just being very organized and having a nice presentation. All of those things will go a long way for you as you're seeking to gain approvals from lenders. And so what next, in terms of what does a typical bank financing package look like, many of you may know, some of you may not know, but the last 3 years of business tax returns for an ongoing entity should be included. Interim financial statements for this past year end and the prior year end are really important to provide. The last 3 years of personal tax returns for all 20% or more guarantors in the business or owners. A loan application, and then projections. As you know, many times SBA affords financing based on a projection model. So historically, if a bank looks at your cash flow and says, we really want to provide financing for $1 million piece of equipment, but historically you don't qualify with an SBA type of product and program, we can look at that. So that's an advantage, no doubt. The other thing is in terms of rate and terms, et cetera, the 7A platform can either be a fixed rate financing and on typical terms can be up to 10 years when it's business assets. And it's fully amortized over a 10-year period. When we look at equipment, or we look at real estate, in particular, we can go out up to 25 years, just as the 504 loan does too. So there's some, and that is a really nice type of amortization in term because you know that you can count on that monthly payment for a period of time and that commitment by the lender. Rates vary. Some banks are charging or offering a floating rate option. Huntington does that. But in terms of the maximum amount of, or maximum interest rate, we're looking at prime plus 2 3/4%. Generally, you can come in prime plus 1.5 to 2. So the range really depends on the risk of the deal and the strength of the borrowers and a whole bunch of different variables. Now, in terms of the underwriting process, it varies from bank to bank. With Huntington, we're able to provide a response within 2 weeks. Other banks have different time frames. So it's a depends kind of response. And in regards to other bank services, I think we talked about checking accounts. There are wonderful treasury management products and services available to business owners coming in. So when you come in and you're looking to establish a relationship with a bank, don't limit yourself to just the checking account. Find out what other products and services are available. There's international wire, there's fraud protection, there's a variety of different services that are available. So I just really wanted to, in a nutshell, cover all of those things, and I'll turn it back to Michael.
Great, thanks. And then, and I'm going to, and Jake, question for you on this program for the 504. And we've talked about it, and it works really well in economically challenged areas. It definitely works for those things that are a little bit more risky. And as a lot of companies that are setting up, there's really 2 different thresholds with it. But talk to me a little bit about a total, basically a deal size through a 504, and the different capital requirements or the equity piece. And I'm mainly talking about the more riskier ones. So.
Yeah. So in terms of deal size, it can range, of course. The smallest project sizes we tend to see are probably $350,000 to $400,000 in terms of total project costs. And then there's really no limit. So in terms of, because it's a partnership loan where you have 2 lenders, there's a maximum that the SBA can do, but there's not a maximum on the other lender. So we've seen projects of $25 million where the SBA takes just 5 or actually up to $5.5 million if the borrower is a manufacturer. So the SBA increases the limit for manufacturing, because that's just an industry that they're sort of really interested in supporting. So deal size can range from very small to quite large, and industry-wise, we go from hotels, restaurants, manufacturers, professional services, medical facilities. So it's a wide gamut. There are certain things that aren't eligible. It's generally it's sort of the SINT industries. It's a government-sponsored loan, and it's the same whether it's 7A or 504. What you can't do, so we can't do casinos, we can't do strip clubs, things that you'd probably assume that the SBA would want to do.
Cannabis loans, medicinal
Yeah,
marijuana.
we're not doing cannabis yet.
Not yet.
And then in terms of different equity injection requirements depending on the riskiness of the deal, so for startups, the SBA does require you can do a 504 loan and a purchase for a building if you are a startup, but the SBA does require 15%. And depending on the type of building, if it's a single purpose facility, meaning that building can only be used for one thing. And why that's a little bit riskier is it means that if you're trying to resell it, you only have one type of buyer that can come in and buy it. So because of that, they increase the down payment requirement and the amount that they want to expose themselves to it. And so in that case, so if you're not a startup, but it's a single-use facility, it would be a 15% down payment requirement. If you are a startup and you've already been pegged at 15%, then it increases to 20%. So you never get more than a 20% requirement. And then generally, and Arlene, tell me if I'm wrong, but
Sure.
Generally what we see is conventionally, if you do a commercial real estate mortgage, usually 25%.
Up to 30.
Up to 30 is standard for down payment. So why this is really a great product for businesses, particularly in more challenged areas or just in a small business in growth mode, is you get to preserve capital. You have a bank that's more likely to approve it because they may not have had the appetite for it just as a standalone conventional deal, where they might have had 75 or 80% exposure, but they're more comfortable with only 50%. So that is how you get banks to participate in these projects. It's a way for them to mitigate their risk. It's a way for the borrower to preserve capital and lock into a fixed interest rate. And then the SBA hits its goals by creating jobs and supporting small businesses on a state-by-state basis to grow the economy.
Great. Oh, Shai, you have a question.
So I'm just trying to understand if you have a project that's, say, $20 million, and you've got a bank that will lend 60%, so they'll lend the first $12 million. And you can come in and lend $5 million, so the borrower needs to come up with
Three.
Right.
So it really comes down that the way that it works is that from a deal perspective, this 504 money almost becomes like a mezz loan. It's, a subordinated loan that takes the place of what equity is going to be.
Yep, that's right. It is subordinated to the first lender. And yeah, as you said, it doesn't have to be 50-40-10. If you have a really large loan, the SBA is always going to be capped at 5 million or 5.5. So the percentages may change accordingly. But you got it exactly right.
But it always works where as long as yours doesn't go beyond the 10% or 15%, depending, or 20%, as long as you're capped at your exposure being the first 85% of the loan. So you can be subordinated for 60% and you're just taking the next slice, but you can't be the last, 100%.
I think you lost me at the last 100.
Yes.
With a 75% loan, you can't come in the last 25%.
No, it would be 15%. Yeah, because
Right, there's
we would
always-
stop at that.
10% equity is always required,
Yeah.
no matter how you slice it.
And so we look at it too because it's fixed assets, so it's loan to value. So the value for whatever asset it is, whether it's real estate or equipment, that 90% is tied to that value. So. And so SummerCore, all of our deals are done with banks. And so oftentimes you have banks that come to SummerCore because they say, we don't want to do this ourselves. We'd rather have a CDC, take some of the exposure, mitigate our risk. Or they just know it's better for the borrower. And many times, SummerCore has built a reputation in the small business community. People come to us first, and we find banks. So it's sort of a two-way street in terms of how we find our deals, and we work with townships and municipalities too. We have people on our board from townships and municipalities, so we love it when we can be helpful for their constituents to expand in those areas. And we are happy also to say when we're not the right fit and refer, if it's a 7A deal, if it's got, in addition to some fixed assets, it's got a lot of working capital needs in it that we can't finance. We have great relationships with other lenders, even if we're not the end lender on the deal. It's something we pride ourselves in doing a good job of, is connecting to make sure the borrower ultimately finds a home.
Okay, great. And so I know we're starting to run long, and so I want to thank our panelists here. They're going to be sitting around, they're going to be hanging around a little bit later after I wrap up the program. So I look forward to talking to you guys more. So again, thank you so much.
Yeah.